Free cash flow, FCF. Valuation estimates the intrinsic value of a company based on its projected free cash flows. The principle is that the value of a company is the present value of its expected future free cash flows, providing a comprehensive measure of the company's financial performance and value. Free cash flow, or FCF, is the cash generated by a company after accounting for capital expenditures. It is calculated by subtracting capital expenditures from operating cash flow. Operating cash flow is the cash generated from normal business operations, while capital expenditures are the funds used to acquire or upgrade physical assets. The free cash flow valuation method involves three main steps. First, project the company's free cash flows for a forecast period. Next, calculate the terminal value at the end of the forecast period. Finally, discount the projected free cash flows and terminal value to present value. Let's valuate a company with projected free cash flows of $10,000, $12,000, and $14,000 for the next 3 years, a terminal growth rate of 3%, and a discount rate of 8%. First, calculate the present value of the projected free cash flows. Next, calculate the terminal value and discount it to present value. Finally, sum the present values to determine the company's value, which in this case is $68,209.07. Several factors affect free cash flow valuation. The growth rate influences the terminal value. Higher growth rates increase valuation. The discount rate reflects the risk associated with the investment. Higher discount rates decrease valuation. Capital expenditures, which are significant investments in physical assets, can reduce free cash flow. Finally, higher revenues and profitability generally increase free cash flow, positively impacting valuation. Free cash flow valuation has several advantages. It reflects the true cash-generating ability of a company and provides a comprehensive measure by including capital expenditures. It is also suitable for companies with fluctuating earnings. However, it has disadvantages, such as the need for accurate forecasting of future cash flows and sensitivity to changes in the discount rate and growth rate. Additionally, the calculations can be complex compared to other valuation methods. To valuate a company with more complex cash flow projections, we can define a function to calculate the present value of free cash flows and the terminal value. By applying this function to project and discount future cash flows, we can determine the company's intrinsic value. This example demonstrates how to perform free cash flow valuation using Python. Free cash flow valuation estimates the intrinsic value of a company based on its projected free cash flows. The process involves projecting free cash flows, calculating the terminal value, and discounting these values to present value. Factors such as growth rate, discount rate, capital expenditures, revenue, and profitability impact the valuation. Integrating Python into these calculations enhances accuracy and efficiency, providing valuable insights for investment decisions.